Hello everyone, welcome to lesson 4 of the cryptocurrency course. Now in this lesson we will be continuing where we left off from lesson 3, where we went into depth into candlestick analysis and more predominantly the candle bodies themselves. Now in this lesson we will be going over the wicks and the importance of wicks in cryptocurrency charting from a higher time frame perspective yet again down to the lower time frame. So combining all of this with top-down analysis, support and resistance, and essentially piecing together from lesson 1 to the present lesson and moving forward, trying to piece all of the pieces of the puzzle together to start giving you a full picture of how I look at the charts, what I see, and in general some of the most efficient ways to understand charts and understand candles. So when it comes to the candlesticks, we'll start off on the monthly chart. We'll be using XRP for this particular lesson. When it comes to a top-down analysis perspective, as you've seen, the candle bodies are very easy in identifying crucial areas where manipulation could potentially occur, but also to understand crucial turning points within the market. But what is more important, and what can often be a major misconception when it comes to trading, a lot of people identify wicks as good levels of entries and market exits, especially when trading in and out of positions. However, depending on the situation you're in and depending on the time frame, depending on the chart you're looking, I've always had a very common saying that wicks play tricks, and very frequently, as you can see from within the market, we're going to shatter a lot of those common ideologies regarding wicks. In some instances, they can follow traditional methods, and in other instances, they can sometimes provide an entirely different narrative. So one of the main signs, first and foremost, when you would see candlestick formations like this, a lot of people, in particular just from here, would see huge rejections from the wicks over here and anticipate a much larger potential movement to the upside, because in traditional technical analysis teachings, what you see on baby pips and all of that stuff, you have to remember when it comes to candlestick charting or when it comes to understanding the markets overall, it's essentially no different to the education system. The information you are being fed is very limited in terms of what you actually need to be educated on to succeed in life or to understand life. So the same way the education system misses out on many crucial topics such as tax and all of that stuff, the educational providers that you see, especially those that are mainstream and very popular on Google searches, they are generally just regurgitating the same information. So when you hear that the majority of retail traders are losing, it's because they're all following the same traditional methods, and they are following the teachings of entities that are purposely putting information out there, not necessarily to benefit you. You may learn some stuff from it, but what you are learning is essentially incorrect, and the institutions and the larger players and the market itself will normally revolve and react around what you are looking at as a potential buy or sell signal, and it will likely do the inverse. So let's just clear this chart out and look at the wicks first and foremost. I think XRP is a good example in understanding why we had the analysis come through. So first and foremost with XRP, you may have noticed if you've been following me, especially in the recent week or two, we obviously sold a lot of XRP around the regions of 40 cents up to 80 cents or around 60 cents, but we did go up to 80 cents. Upon pushing lower, and why I'm currently starting to believe we could be seeing a turning point in XRP once again, is due to the wicks predominantly. Now, as you can see from where the crosshair is currently placed, as you guys know as well, the wicks are the thin lines that stick out of the candle bodies. And the way I like to imagine wicks, they're kind of like shadows. They're almost a skeleton or the remains of where price once was before actually being pushed or pulled into a particular direction to form the closure of the candle body. These are the remainders and essentially telltale signs of where price may go to in the future, and especially in cryptocurrency where the market is heavily manipulated, when you are focusing on the candle bodies, the larger the wick region is, the more likely it is prices will come back down to fill the regions where the larger wicks go. So as you can see in this particular instance here, just off the bat, on XRP on the monthly, you will notice this particular level here. We'll get the horizontal Radial where this wick was. Now, when I mark out this wick, make this blue to make it as clear as possible, you can see from a monthly perspective we had the first wick come down here. Now this wick is obviously very significantly lower in terms of downside prospectus, and because there is not too much in relation to prior historical action reacting around this level, we do not need to use this necessarily because it's so far away. And as you can see from over here with this wick, although it has technically come into play a few times, it's not as perfect. Whereas if we were to put the candle bodies down to around here or so, or the wicks down to here, you could see there would be a much stronger level of rejections on this particular level. But when you see a very significant wick spike all the way out in a very irregular movement from the price action, it's normally just a sign of manipulation, and it can obviously push you to believe the price may be going higher. And in this particular instance here, from a monthly perspective, you would have seen this huge candle go from around, let's just say 24 cents or so, all the way up to 35 cents. And in that present moment in time, around the 1st of February 20, we'll just get that period up. We'll go over here. Let's go to the daily. So as you would have seen from this particular period in time, this was looking and seeming like a significantly amount of bullish movement, which from a weekly perspective as well, would have indicated a very large potential breakout coming into play before this level here was obviously spiked and we reversed lower. But when you go back to that monthly time frame and then you see how that monthly candle actually closed and where that wick went up to, you could see exactly how wicks play tricks. We predominantly surged 10 cents higher only to close back down within the same trading price region. So when it comes to these kind of levels, it's always good to, you can mark them out in the absolute worst case scenario, and in cryptocurrency relations, of course, you can see some incredibly large wicks or some incredibly large candle bodies. But in this particular instance, looking at XRP, just to use a real life and current scenario, we can see this particular spike here caused a reversal of some sorts, which then led to a spike higher, followed by the large wick that pushed to the upside. So something caused, and the reason we look at wicks more significantly is something caused price to spike down to this particular region and reverse back upwards and then continue higher. When you see a confirmation bias such as a candle spiking higher and then the next candle pushes even higher, it's usually a sign that there is some form of significant buying or selling pressure at this particular level. And obviously in this particular instance, if we just push that a little bit higher, we can see from the candle bodies here, even when we went all the way down to around 11.5 cents, the monthly candle still retained this particular level. The next candle, of course, opened and surged upwards. The following candle almost taps this level. The following monthly candle arrived at the same region, and the following candle then rocketed from this region. So very clearly, from a period of the 1st of December 2019, pushing a year later, exactly 1 year later, we came all the way up. And what are the chances that price spiked all the way to almost 80 cents and then came all the way back down, wiping out the prior month's entire gains to come back down to this exact trading region? So when you're looking from a longer term perspective, and this isn't just for trading purposes as well, this can massively aid you in identifying longer term areas to accumulate long term buys. So if we get off the log scale, there will be a lesson coming on the log scale very soon as well in the near future. This is something I've been experimenting with recently and I find it very beneficial. But having a look at this very quickly, understanding that there is a crucial level here. If we drag this back even further, just to see how it correlates with prior price action, we can see, despite some false movements lower, there has been a lot of trading activity around this area. So what you could do in this particular instance is plot maybe the candle bodies there as well, which obviously showcases yet another level of crucial support where candle bodies manipulated their way through. And if we then correlate this with future price action, we can see it aligns quite nicely with those much smaller wicks that have been pushing through this region. But overall, the candle bodies remained in this zone. So what you could do when it comes to longer term buying opportunities is understand if the market has held this floor, and if we plot a zone to illustrate this a bit clearer, we can see in general, especially on the Kraken chart that we're currently using, all in all, despite how high we've gone or how low we've come, this has been a significant staple level of support, and we can use the candle bodies in combination with the wicks to identify crucial areas where the market can pull back to reject and instantly spike. Identifying much smaller wicks as stated in comparison to larger wicks like those up there, although that was very close, you are able to potentially identify those crucial turning points in the market where price will almost instantaneously tap this level and then ping back higher. And as you can see from a much more zoomed out perspective, from that entire growth to the entire pull down, it came in, tapped this level, and now it's retaining and maintaining above. When we go to the weekly time frame, we can use this yet again to predict a potential trading range of where price may be going next. Now, having a look here, we could use this level as it has come into play before. As you can see, it was once a level of resistance, and prior it's become resistance, support, resistance, support. That is a very crucial level. However, it's also a very wide range. So we want to be looking at the candle wicks that are more relevant to the current price action. And all we would do in that particular instance is plotting this around there. As we can see, the first real wick that came through spiked up. We'll make this one green. Now, as we can see, wick spiked through, came back down, spike and spike again. By plotting these levels on the higher time frames, such as you can even see from the monthly over here as well, and if we even push that back even further now, thanks to the monthly outlook, we can clearly see rejections all over the place. And very frequently, when price heads into these particular areas, you're going to see very frequently a drastic reversal in the opposing direction, whether that's short term or long term. When price comes back to these areas, we are identifying these regions as some area where, in this instance, if we add another level in line with the candle bodies now, as you can see from this candle body here, we will align that higher around here. Now, as we can see how this plays out with prior levels of support and resistance, there is a huge accumulation of support and resistance fluctuating between these levels. So mirroring the exact same procedure, we will mark this zone out as well in synchronization with the other levels we just marked out. We will make this green, and now we can see two particular zones when once dropped down to the daily will enable you to find crucial turning points within the market. Of course, we have to factor in the potentiality for false moves to the upside first. This is a very frequent occurrence in the cryptocurrency market, but overall, understanding the monthly and weekly wicks will enable you to create that trading zone to optimize your trading. Now, as we can see from here, from the weekly, we have a nice zone now where price is rejected before. And of course, if you wanted at this current point in time to identify a slightly better zone, you can accommodate that more closely to the candle bodies and wicks of this particular region. So if we was just put that around there, we're almost near that wick or even near the candle body over here. This is a very good example as well, actually. So you've got the candle body there, the candle body closed there, and then wick, 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 broken through, wicks all over the place, candle body closures, and wicks, wicks, and more wicks. So we can now refine this, push this to around there to align yet again with, plot that there, now plot a zone. So we wouldn't be able to factor in a lot of the manipulative movement by doing this, as you can see. However, from the weekly perspective, it does look very good, and it gives you a nice and very easily explainable way to illustrate the crucial turning points in the market. Of course, as stated, once you go to the daily, a manipulation can occur much more than expected. So in these particular instances, a breakout of this level would occur. But this is where you focus on those weekly timeframes to understand that the candle bodies themselves and the wicks were just manipulative. And again, the wicks play tricks. The daily perspective, it broke through, it rejected. Many people would have been anticipating a huge movement to the upside. But once you go back to that weekly time frame, it pretty much remained within this region. Now, a good lesson to come into play from this level here, and this is one of the most powerful tools that I use when it comes to utilizing wicks for the purpose of identifying turning points in the market. You will note in this particular region here, the candle bodies actually breached above and closed above the level of resistance and the resistance zone. So no matter how we draw this zone, whether it's as small as this level here, or whether it was as wide as it just currently was, all in all, this has been a crucial turning point in the market before. As you can see, price literally slammed down, closed within this zone, and then absolutely rocketed from 29 cents up to around 51 cents, just shy of 51 cents. So very clearly, when there are crucial turning points in the market like this that repeat themselves and historically come through again and again and again, we have a nice understanding of turning points. And as you can see, support, rejected, support, rejected, support, rejected, rejected. However, do you notice this time it was more of the wick that spiked through, but the candle bodies remained much higher? That's normally a sign that there is going to be a significant push lower. And this will be another example of wicks playing tricks that we will get to very shortly. As you can see over here, the candle body did close below, but we did see a huge wick pushing down. The majority of people and market participants would view this wick as an incredibly bullish wick because it remained within this region. However, this can often be a sign of the opposing situation happening. But again, we'll get to that in due time. The most important focus for now is trying to identify how manipulation can occur in the markets. Now, the same way we plotted some of the most crucial wicks on the monthly time frame, when it comes to the weekly or the daily, and let's just say we've seen this incident now where it's broken out, and many people would be anticipating a continuation higher upon the break of the resistance zone. What we would do in this particular instance, again, the monthly obviously showed us a different situation, but in a real life scenario, it's not as easy as simply predicting such a thing or waiting for the monthly candle closure. And just to be completely honest with you, it's very easy to say these things in the present moment, but in real life, the situations can often differ. So if we went to the daily as well, again, just to show you rejections, rejections, rejections. Once you see the first candle spiking through and closing and maintaining this area, you simply plot a horizontal ray or a horizontal line. We'll make that blue. At this wick region here, we now have a level almost within the zone itself, which would probably correlate almost precisely, as you can see, with prior wick activity around this area. But let's just say we weren't looking at this and we didn't see this. We were just monitoring this from the point of a breakout to the upside. So what we would do in this particular instance is wait for the first weekly candle closure and see where the wick has lied. This is now the shadow. This is the remainder and the remains of where price once was. So we would be looking at this now and try to understand this not just from a candlestick pattern or a candlestick formation basis. I personally do not really even look at candlestick patterns and formations. For those of you who follow me, you will know that. I do look, however, at a bit of a deeper level and try to understand what it was that caused price to go up to this level and plummet it all the way back down. And why could this potentially be coming through again? The same way this level absolutely blew through the roof, tapped here, pulled back down. What caused this to happen? There was obviously, and in terms of understanding the market procedures and how the market operates on a cryptocurrency scale, the majority of market volatility, especially on a pair like XRP, which is heavily manipulated, just like Bitcoin and many other altcoins as well, market manipulation is a crucial factor in trying to identify where price goes next. So understanding that crucial levels where institutional traders, hedge funds, or even whales, players with very large holdings and amounts of cryptocurrencies, insider traders, they tend to work from potential levels. Now, if you know how a hedge fund or any kind of trading firm operates, they frequently and more often than not will not execute trades with a market execution. They will exit and enter trades with limits. So in particular, executing a trade will come from a buy limit or a sell limit. So what that means is they are premeditating levels in advance, where this can seem like insignificant movements to make money for people like me and you. But for institutions with millions or hundreds or tens or billions on the line, these frequent movements here allow accumulation of assets or coins before potentially shifting price in the opposing direction. So when we would see this first spike here, we would look at this and go, okay, it spiked to around 32.5 cents. Something has evidently caused price to crash around this level, which tells me this exact price point of around 0.325 approximately. Remember, when it is a perfect rejection of a round number or a clean number, it's more likely going to occur. But in general, if it spikes a little bit through, sometimes there can just be a little bit more of a push, but it doesn't necessarily invalidate the theory. So we would then look at this level and then go to the daily time frame, and we would understand that if something has caused a huge spike to the upside here, it's inevitable that something else may cause another push here to come and validate how strong the selling pressure actually is at this level. And this is where you could even increase this a bit higher on the daily time frame. And all we would simply do in this particular instance is, it is a gamble, so is the majority of trading if you do not know what you're doing, but trading from levels where wick rejections are commonly occurring enhances the possibility of a higher reward and less risk on a particular setup. If you've seen a huge movement up to this level and then a pullback, what you can do is go to the daily time frame or even the 4 hour. You could set a potential sell limit at this level here. You would need a much smaller stop loss, and let's just say you were going for, again, you couldn't really go too far down, but let's just say you were simply going for a retest of broken resistance that would turn into support. We'd mark this level out here, which is exactly where price currently is right now. As a matter of fact, you could put your TP to around there to retest the broken support, which inevitably in trading is usually how it goes. And market cycles and market dynamics, when resistance is broken, it will generally come back down to retest the support. When support is broken, it will come back to retest as resistance. So in this particular instance, you would have had a very high probability trade setup that you would have been able to execute with a very small stop loss. Of course, you wouldn't want something like that, because regardless, in cryptocurrencies, the spreads will eat you alive. But in general, you would have had a fairly small stop loss and been able to achieve relatively easily around 10% on a simple setup from executing where market manipulation occurred. This is obviously a lot easier in a range-bound market, but even if you wanted to go for a much smaller movement, like the single movement down first, you could have got anywhere from 7 to 6% off a single movement like that. And obviously with a smaller stop loss, this could have been anywhere between 13% potentially, just from catching the major high turning point and understanding that when price comes back and fails to reject, it will likely trigger your sell limit and you can easily just go into profit. Another good example, going to the weekly time frame, is the present point in time now. So I will clear the drawings. We will go to the daily. One thing that's catching my attention right now is this level here. So when XRP crashed and we went down to the 20 cents region, which I will mark out here for you now, we can see from a weekly perspective, we've spiked lower, but the candle is now back above this region. And again, understanding how this works, as you can see exactly there, the rejection, as we just covered, exactly there. You can spot these all day long on XRP, and that's why it is one of my favorite pairs to trade. Because as you can see the wick level here, if you had a stop loss just below where the candle bodies are, or let's just say the manipulation occurred first. Normally, when the first manipulation occurs, the following candles will not likely come back down and go down as far. You can get rare instances where a candle will spike even lower to take out the manipulative candle further and then continue higher, but in many instances this is not the case. And as you can see, there are many factors you can combine with this. So you would have had, from this particular understanding alone from the weekly, there would have been an entry potential. Let's just plot that again. We wouldn't have known how far it would have gone, but let's just say we plotted that there. Now, I obviously would have had a stop loss around here or even a bit larger, depending on the span of trade I was looking to capture. But we would have had one potential entry opportunity there, another entry opportunity there, another one there, another one there, and one more there, which spiked through. In fact, that one wouldn't have counted because, as you would have seen, the candle, the wick does not actually touch this level precisely, but the weekly time frame is giving you that bigger picture. And what would be very interesting to see, as a matter of fact, is XRP within 2 hours and 40 minutes, the weekly candle closing back above this level, which would have confirmed even further a major level of manipulation occurred on the weekly, but price still retained at this exact level. Now, putting this aside, looking at the present price action, when you dip down to the daily, the most important thing that catches my attention right now is the significance of price dropping all the way down, finally tapping this level, and as I said, the following candle then reverses higher. I placed the majority of my investments around 23.1 0.231. But as we pulled lower, I wasn't scared, and I didn't even really bother going in further, because what we're looking at here is the level where something has caused price at 20 cents to fall from 80 cents down to 20 cents and then somehow finally find sufficient buying pressure. We obviously have a very significant level in play. So ignoring the likes of the 4 hour, which would have scared many people, as you can see, as you dip to those lower time frames, it becomes more complex and it's harder to determine exactly what could be going on. As we could see here, candle body slammed down, respected this level perfectly. This level went from 20 cents up to around 38 cents, almost 39 cents. It then came all the way back down, and guess where to? Exactly at this level, before breaking lower, wiping out anyone that would have gone long at this region, and bang, straight back up. And then what happened precisely from this region? And judging from XRP right now, I wouldn't be surprised if this just absolutely booms to the upside, but we'll see what happens. Again, going into wick activity, we'll explain this all further as well. But looking at this, it broke back through, came back down, rejected the level precisely, came back up, taps this level again, and continued higher. So in the event we saw any form of manipulation to the downside, we would be able to utilize this level to identify potential entry opportunities. When you go back to the daily time frame, you can see how insignificant those wicks suddenly become, because regardless of what's happened, the candle bodies have not breached below the incredible area where a large amount of buying pressure has occurred. So all that tells us is we've seen some spikes through, spikes through, spikes through, but the candles are not managing to go below just yet. So by identifying this potential situation, we are able to determine that price is currently maintaining above a major buy zone around here. So even if we drew the zone from where the candle bodies were situated here, we can see again another tap. So what we would be looking at in an instance of executing a trade, if we were to go to the 1 hour time frame, we would be looking around this particular level, and of course extending this to where any form of little bit of wick fishing activity occurred. So we would mark this level out, draw our zone, we will make that blue, we'll go back to the 4 hour, and we can identify that anywhere around this region, which was a major and crucial turning point, if we were to see a drive down into this area, we would then look for a long opportunity. Nothing is ever guaranteed in the market, and there's no guarantee this will work 100% of the time. But by looking for entry opportunities around the regions where the majority of market manipulation has occurred, you are putting the odds slightly more in your favor. And what we could do from this instance is, if we understand that sometimes it just taps or sometimes it spikes a little lower, we wouldn't want to potentially miss an opportunity. Now, from a trading perspective with margin and leverage, we obviously would look to ideally try and let it get triggered with a slightly wider stop loss going for a longer term trade. So in this instance here, we've seen manipulation has occurred to this level, so we would want to put stop losses just a little bit below where this level has occurred, just in case it comes back down to that level. And then what we could do from there is look for the rejection of this level. If you're market executing, by all means you can manually enter if it dips within the zone over here. But all in all, let's just say we put it from the line of around 20 cents where we have seen significant buying pressure occur. This of course was fake. So judging from that movement, we could then anticipate from what it's done before to what it's done already, it could potentially lead to a much larger movement. So if you were to mark out the prior highs we went to of around 38 cents, you would be able to plot a nice trade setup, providing you a 5% return with a 1% risk. That for me is an incredible risk to reward on a very short term setup. Because you're looking at it from the 4 hour time frame, it can look like it's a very large move, but in the grand scheme of things, and judging from how fast cryptocurrencies move, this could very easily escalate into a swing trade that, for all you know, could result in 20% plus. And that is how you can leverage the best opportunities in the market. More importantly, there's many more ways you can utilize them in a similar manner to what I just showed you. A very easy way to understand this, yet again, I know we've covered this particular instance, but to mirror what I just said, you see the wick comes up and spikes through, the candle comes back, rejects, it goes back down. We can see this mirrored many times over. We plot that through, and exactly how, even though this is on the daily time frame, how we had the false move on the 4 hour here, breaching the wick, breaching through, spiking back up instantly. If we now go over to this level over here, we saw the rejection, we broke a bit lower, we came back up, we tapped almost precisely at this level, just fell short, continued higher. Where did it come back down to when it reversed? Back down to the same level. The same can be said of almost everywhere around these regions. I could very easily plot this level for you now. Rejection, rejection, rejection. False breakthrough, bang, it comes back lower. So sometimes, even though I'm not one to really enter on a candle once it's going in the direction I favor, I tend to opt for, it can seem more tricky to enter when the candle is opposing the direction you actually want it to go in, but that is how you gain a more optimal entry. So a good example would be, this for me would be a beautiful short opportunity, because we've seen the wick come into play over here. So I'll place a stop loss, let's just say around there, because we haven't really seen much of a breakout yet. You can use prior wicks as well to kind of aid you in where the candles are going, but let's just say in this particular instance, we were looking at a very simple trade of around 4% or so. Judging from what's happened prior, we would then see that prices come through, and for the sake of making this a little clearer for you all, we'll make the bearish candles blue to kind of differentiate between what's going on. So many people tend to execute trades once they've seen a confirmation bias of the candle going in the favor they want. The problem with this is, granted, you could enter here and place a much wider stop loss, but as you would have seen, I was looking at around 4% from that particular setup there. By now dragging this back to a similar price point, you're barely breaching 2%. So what I tend to do, utilizing the wicks to maximize my profitability, putting that back there, I'm not sure why the candles changed without moving, but we can fix that relatively quickly. We can see that when you actually go for a candle and execute upon a rejection of a particular zone where price manipulation occurred, the color of the candle does not matter, and that is why my candles are one color. But for the sake of educational purposes, as you can see, when you have a bullish candle like this, many people would be terrified to potentially enter short. Because why would you? It's an incredibly bullish candle. And this is the same theory I apply to the likes of a bull run within the market. Because when price is absolutely surging and you do not see any bearish candles, or you see a few bearish candles but loads of bullish ones, you can become blinded to one bias. But when you change all the candles to one color, you eradicate that bias and you trade predominantly off the actual levels that are occurring in the market. And the majority of your success in trading, once you start practicing and utilizing these methods, this will revolutionize your trading, by the way, guys. As you can see, it's very simplistic. It does take a lot of practice to identify which ones are relevant, but you can see all in all how powerful these methods truly are. We can go to, again, this is just small price action as well. This is just a range that we broke out from. And again, as you can see here, if we see a weekly candle closure back in this range here, that would signify for me that this is looking to start turning around now. We see it many times over where you see the candles rejecting into a particular area. And if it does maintain this level, we are going to see a reversal. Now, the reason I anticipated, little trick for everyone here, the way I managed to predict the reversal from these regions down to 25 to 16 cents. That was my final target, but it only hit 17 cents. What do you see here? And this is why I unfortunately didn't buy, but I probably should have. What can you see from this crosshair that sticks out to you in particular? If you look to the left, we have this level here, we have this level here. So if we were to get rid of this and go from an even further outlook, getting rid of this, getting rid of this, getting rid of this, this is what really stuck out to me. And if we go back even further in time to make this all correlate, you can see how it's come into play before. A huge rejection, which actually caused the last bull run. Rejection here. So imagine this, price fell all the way from $3.3 all the way down, and something caused it. Remember, because this is near the lows, it's more significant. This was obviously the false breakout, as I've covered many times. This was one of the real significant reversal points. So something here in correlation with prior levels means there's a significant amount of secondary buying pressure from where the 20 cents region is. So this was essentially the manipulation zone. Now, we knew this zone was relevant because once we actually spiked up, again, we came back down. If I go to the daily time frame, we can see we annihilated this level, we came back up, we finally broke through, and yet again, what happens? We spike precisely, we spike up. We come back down, we just fall short. We come back down again, we spike through, but all of the candle bodies remain within this region. And what a beautiful trade opportunity that would have presented for us all. I mean, if you were to ride that entire wave with even a modest stop loss, you would have been looking at around 8%. And obviously, if you're going even wider, even a 6% with a fairly wide stop loss, you would have been able to utilize a very large movement. But obviously, because of the strength of these levels and because we've already seen the force manipulation through, once price reaches and goes back above this level, it's more likely going to retain, maintain, build up positions, and boom. And this is how trading works in crypto in particular. It could have even been like 11 to 15%, depending on how risky you were with your stop loss. But again, huge trading opportunities by trading from these levels. Whereas, if you were to follow traditional guidelines and enter from here, once the bullish confirmation has come through, you're significantly reducing your profitability. We went from almost 20% to anywhere now to around 4%, even if you went lower, 5%, and there 3% from following similar principles. So just by waiting for those particular entries, minimizing your stop loss, you can massively increase and almost double your profitable opportunities within the market. So that's one of the main functions to take into consideration for WICKS, and also combining these in the next lesson, I'll show you something even more interesting with that as well. But again, over here, very similar situation. Saw a much larger spike through. But as we can see, regardless of what happened, this is the wick area. We spiked a lot higher. That probably would have wiped me out, to be fair, if I was entering from that region, just to be real. However, let's go back. There we go. We can see, despite the wick that went higher, what happens? What do you notice? The candle bodies remain within this region. Little false breaks through like that are very insignificant. Spiked through, came back up again and tested. And this would have probably been, in all realness, my short entry from this rejection here. This would obviously have to have been accommodated because there would have been a secondary area of potential liquidity that price could have spiked to. But all I would have done in this instance is executed around the rejection of this level. Stop would have been above the wick around there, and I would have pushed this lower. So that probably only would have been a 2.5% trade. But when you go to the daily, boy oh boy was that daily looking juicy. You could have maintained with a swing trade all the way down to the secondary level. That would have been around 8%. And obviously if it pushed lower, then granted. But again, this is an example. In real life situations, many people do not hold the whole way. So in grand scheme of things, when you zoom out, you can see even with a slightly higher stop loss, you would have made a very good risk to reward. Your risk would have been tiny, 1% as always, very frequently, or I will stick to 1%. Occasionally, I will go to 2%. It all depends on how much profit I've actually made in the market. There were times when I was shorting BTC where I actually risked 5% in total on BTC shorts, and it actually ended up going to around 7%. But the only difference was I risked 7% of the profits I made throughout the entirety of 2020. So when I'll be showing you in future lessons the understanding of risk to reward, again, there's risk to reward lessons covered in depth in the app already, in the Innovation Markets app, but we can obviously elaborate on this further as well. There's always content that's able to be covered. But if we just go back, in the real life situation, I would have entered around here. We would have seen a little bit of drawdown. Again, probably would have been around there, around 52 cents or so. That would have just been a general rule of thumb for me, something I'll be explaining in the future. A little bit of drawdown, but from a daily perspective, all it was a single wick, and you would have gone instantly into profit the very same day. But that is why the higher time frame is crucial. You don't want to be looking for everything on the 4 hour. You want to be using that to identify what could be going on. And sometimes waiting for a level to come through, as you can see almost every single time, a crucial level or turning point in the market, before we see a major continuation, there is a breach lower first. And exactly as now shown from this level here, we've seen a breach lower. Now we can just anticipate, and hopefully, if it doesn't already just explode to the upside, which I do have a feeling this thing's going to do, If you guys are following me, obviously you do know that I'm expecting it to probably come to around 60 cents very soon, and a huge upside movement following the false allegations of the SEC lawsuit, blah blah blah. But the majority of the time, fundamentals do not come into play, and this is a very important lesson. The wicks and the technical analysis will allow you to understand the potential locations of where price will be going without actually having to know what fundamentals will come out to affect this. The fundamentals will usually drive price into a particular targeted area for you. Now, to make things even more simple, yet again, just to go back to the daily now, this would have been an absolute work of art. So from a daily, as you can see, you probably would have missed that level, and that would have been tragic. I probably would have cried. I didn't actually recall ever paying attention to such a movement, but let's just say we marked out that low there and price fell just short. That would have been very upsetting. But from a weekly perspective, as you can see, it would have just fallen short as well, which is very unfortunate. But a similar occurrence comes through, and again, there are instances as well due to spreads, and this is probably actually a good lesson to come from this. There are times where, due to spreads, if you were to put your level, especially in crypto where the spreads are not as low as the likes of Forex, if you were to put your level or your entry or your buy limit precisely at this level anyway, it probably wouldn't have triggered due to the spreads. It would have had to have gone down to maybe around 0.24, maybe even lower to trigger. So sometimes you need to put your entries a little bit higher above the level anyway for them to actually trigger precisely around this level. But that, of course, is dependent on your broker and all those other factors, blah, blah, blah. Now, the next thing I want to cover, probably the final thing I want to cover regarding WICKS, is the misinterpretation of how they actually work and understanding them as predominantly reversal signals, whereas if I can find some examples here, they can often prove quite the opposite. So, exactly how I showed you here, how the wick reversals come through and you can see rejections. When you're looking at candles coming into play, good example would have been here. This for many, these two candles here, seeing these two wicks, would have been a major sign of a turning point in the market. Let's go to that so we can see the wicks more clearly. People would have looked at this as well, which again, that would have been a beautiful entry for us. We'll mark that out as well to get back to in a second. People see these particular levels here and they expect them to be huge catalytic movements for price reversals. But as a matter of fact, if the overall market is trending downwards, again, watch the prior lessons for trend identification, these kind of wicks normally indicates that price will be coming back down to fill these areas, especially when you see a very irregular wick. And an even better example, as a matter of fact, would be this wick here. What a beautiful wick. Again, it has no real relevance in the overall price action because the spike has occurred down here. So if you see a candle spiking down here, it often doesn't mean it's going to be a major reversal because the crucial turning point in the market has been solidified at around 0.284. So if you see a huge wick like this coming through in an area that's pretty insignificant to where the actual low has been posted, it's more likely than not actually an indicator. And this is a very important lesson to take note of. I've rarely ever told anyone about this, but that is why in these courses I'm just throwing everything out on the table. I do not care. In this instance, we would look at this wick as an actual guideline of where price may come back down to in the very near future. Whilst many people would be looking at these as potential reversal signs, I look at these huge irregular wicks as identifications of where price could potentially go to. And this could also provide a nice opportunity for intraday trades. By using the weekly and daily wicks, you can identify where price may potentially come back down to fill again. So if we were to mark this out as a zone, this wick here, from there to there, when it reversed, you can see the candles went up, they broke through, but inevitably, once it came back down from the candle body to the entire wick, it was inevitably filled and price came all the way down to fill this area first before rejecting it as resistance, pushing down to the actual level. And if you weren't paying attention to this level, you probably would have shorted here because you would have seen a break of support, rejection of resistance, continuation lower. But as a matter of fact, despite that tiny little bit of manipulation lower, this would have been the real level. And that is why you have to focus on the bigger picture and understand the much larger crucial turning points in the market. Because if you're too fixated on the little wicks like this, as you can see from the daily yet again, the candle spiked, bang, it got entirely filled. And another good example of what could have been an intraday trade as well was this huge wick up here. So again, you've seen a huge wick indicating for many people what would have been a reversal in the market. But again, the major spike was up here. And this would have been horrific regardless. I mean, it wouldn't have been a very good ending for anyone. But looking at this wick over here, in comparison to where this wick spiked up to, it did not fulfill the full region of around 40 cents up to around 0.400. So if we would just drop down now to the 4 hour and go on here, we would have known that there was a huge potential for price to come back and fill this area. So even from the following movement here, when it pulled back down and tapped into this level around here, that would have provided a very nice intraday opportunity. And very clearly, when we saw the support for formed, this would have been our target anywhere up to the second level. But if we go back to the daily, just to show you probably more clearly, all we would have done is judge from the bottom of the wick, as you can see around here. There's a wick and an area to be filled. Price, if it instantly reversed, obviously wouldn't have mattered. But because it's in an insignificant area, we know something must push up to potentially validate the strength of this level, which we obviously saw proven. You could have easily entered a trade from this support floor when price came back down over here, up to this region here, stop losses below. That would have been around a 4% trade. Obviously, if you weren't at your desk and it suddenly blew up, that would have been an 8% trade. But all in all, you would have been targeting anywhere from the high of the wick up to the prior wick region that caused a major turning point over there. Obviously, if you didn't take profit, you would have been annihilated. But all in all, using the guideline of the low of the wick, you could have had stop losses anywhere from there. Because remember, this would have been an intraday trade. So if we go back, from an intraday perspective, you would have caught the low of the wick. Candles just safely below where this wick region was, could have been anywhere from there. But obviously understanding there was a crucial turning point here from an intraday perspective. So you obviously would have wanted to have that a little bit lower. But all in all, that would have been a beautiful opportunity to achieve anywhere from 5.5% all the way up to a whopping 10.42%. There are opportunities everywhere within the markets for this. Now, in this instance here, this is when you can start to identify a potential reversal sign, because not only have we had the forced breakout on a much larger scale of that wick region and crucial area of selling pressure, we've then seen 3 wicks in a row rejecting this zone. So it's inevitable that we're going to see a pullback to the level. And from a 4 hour perspective, look at what happened here. Price plummeted, reacted exactly as support where we were once at resistance. Bang, spiked through. And if we zoom out, we can see after being annihilated longer and later on down the line, it comes through as a level yet again. But it's always important to try and use the weekly and the daily to focus on the most relevant turning points in the market. And I think one of the easiest ways to identify that, as you can see as well, this is a very good example. This was a major manipulative point, but you remember when I said sometimes it's just too high? It came through perfectly, as you can see over here. It would have reacted, bang, the force move through again. But if we were to simply plot our levels where the prior wick was and where the majority of the major reversal occurred, we would have been in a much better situation to enter a more optimal entry position. Whereas if we pushed it a bit higher to match this wick, we would have had to have occurred a larger stop loss to cater for the wicks pushing to the downside. So in a nutshell, that is one of the easiest ways to trade the crypto markets. But again, it's all about having that longer term mindset, and instead of being so fixated on these movements. And a good example was when I did enter here, everyone was going, oh my god, it's going against you, it's going against you, oh my god, what's going on? When you zoom out and you start to allocate all of the levels where turning points have occurred before, this could simply be understanding the accumulation zones and the general rule of thumb. If I just mark this level out for you, maybe from around there, just to be a bit more precise. So anywhere where these wick activities have occurred, it seems to be a major zone of accumulation before significant movements come through. So it's almost inevitable to understand that price manipulation occurs to come to where the prior wicks came through, which is giving you a telltale sign of what's happened before, false break, push back higher, and this is almost a larger scale version of everything I've just showed you, and that is why I'm fairly bullish on Ripple at the moment, because the same way I showed you how from a weekly perspective, so imagine this is why I believe something huge could be coming, because we are everything I've just shown you from the wick point. Again, there's also the possibility with this down here that we could come down to around 13 cents or so, and I did have an order at 13 cents, but it's now at 15. But in the event this comes through, many people will not have this plotted, so they will not even take this into consideration. They will be more fixated on something like this and identifying the current price action, but not where the real manipulation is occurring. So if something like this was to come through, I would be in heaven, because it would provide a better buying opportunity. But just in general, to go back to the level that we covered from here, this is almost exactly what I showed you, but on a much larger scale. What we were normally looking at on the daily and the 4 hour is now occurring here. We tapped, we pulled higher. The false break, we've seen the tap, we've seen the movement higher, and now we've come back into play exactly at this level here. So we may see some more consolidation. Maybe the daily candles will come back down to now fulfill this wick region and maintain around this area with further spikes lower. But all in all, when you start going from a top-down analysis perspective, there's now a new solidified floor, which we can now make green just to differentiate between the colors. We can then go to the 4 hour. We can see the false break we're now holding, and all we need to really look at now is patience. You just need to be patient now, because it's technically fulfilled this movement. So all we would be anticipating in this region is a pullback back within the 20 cent zone down to around 18 to 16 cents, and this would be a region to accumulate long-term buys, which is what arguably many of the institutions are probably doing, because they wouldn't want to be missing such an opportunity down at these prices, despite what is being told out in the media. And I tweeted this literally a few hours ago. You have to remember, guys, the news outlets, or what you see in the news, do not, I mean, pay attention to the fundamentals, but do your researches and gain your information from sources other than the mainstream media or any form of financial news outlet. Stuff like Bloomberg, all of this stuff, if what they were posting was beneficial, we would all be billionaires. But we are not. And that's because the information they're providing is not beneficial. Otherwise, life would be incredibly easy for all of us. So you need to understand that the technicals do the majority of the time, even though it's never 100% perfect, by understanding the candle bodies, combining that with the wicks, combining that with the trend line analysis, combining that with trend application, trend identification, combining that with everything you've seen so far now in the total 4 lessons that have been provided, alongside everything that's going to be provided for you all moving forward, I have no doubt we are going to revolutionize your trading with the most common practices that people ignore. These generally are the most common practices, and this is why I show you the same candlestick colors. It's not to try and be, cool and hip and different from the crowd. No, it's the most simplistic things in the market that work. Everything that you have been taught is set out to distract you, but by stripping to the raw basics, the clean, simplistic charts, you will be able to identify the full picture without 100 indicators, 100 different colors, 100 different things. Simplistic raw price action is the biggest telltale sign of what will happen next, and that's how I've predicted many of these major market reversals before and major turning points, and just in general actively managed to trade the market successfully for many years now. So I hope you've enjoyed this lesson. I'm going to go into my notes now and start preparing the next lesson for all of you. And more importantly, I hope you guys are enjoying 2021. Lots of content coming forward for you guys. Probably another XRP video soon as well. If not, Innovation Markets members within the app. Back to the trading now. The markets are going back to normality. Forex and crypto, it's going to be insane. Thank you all for believing in us. Thank you for all being with us as well. And guys, man, I cannot wait for this year, and I cannot wait to see what's in store.